And so what you see is too many venture capitalists are chasing too few good deals, and they're chasing those deals in a I'll call it a software realm where the barriers are low and it's very hard to get the returns uh, for their funds. And so venture capital has been underperforming because that lottery ticket is not paying out.
Hey everyone, this is Prashant and I'll be your host of the VC10X podcast, and today we have Robert COTE with us. Robert is the founder of COTE Capital, where they have a mission of finding, funding and scaling breakthrough innovations that can have an impact on the world and bring advanced manufacturing back to America. In this episode, we talk about what is IP capital, how is IP capital different from venture capital, what's broken about the venture capital model, how the IP investing model works, how IP capital turns venture capital on its head, how's IP capital recession proof, Robert's story of investing in PCR, OFDM, and other breakthrough innovations, and how that produced over $3 billion in returns that translates into 112% annual return, and lots more. So without wasting any time, let's dive straight in. Hey Robert, so good to have you on the VC10X podcast. How are you doing?
Very good. Nice to meet you.
Pleasure hosting you. So I'm pretty excited to have you on the podcast since IP capital investing is not something that we have discussed on the podcast before or not in so much detail. So I love to have this opportunity to talk to you about that. But before we get into it, the first thing I'd like to ask is what's your story and how you started investing?
So I began as an IP trial lawyer, IP litigator, and I moved into licensing and enforcement of breakthrough innovations for companies that built industries in America. And so I moved from being a lawyer who understood how to protect people, protect companies and their breakthroughs around the world, into somebody who would actually help them scale the use of those innovations. And so I began doing things like PCR that won the Nobel Prize in chemistry, helping the company that had developed that process and the equipment that is used to actually scale use of that equipment. And that's how I began to realize that a new model was needed in venture capital for breakthrough innovations, companies that are building real physical things that need to scale because they can't do it all themselves, right? They're limited. In the team, they have the manpower and the capital. And so I began with PCR, co-investing with companies like that in helping them scale use of their IP globally in partnerships with companies around the world. Again, having many, many more teams drive cars with kind of the engine that is the breakthrough. And so you provide access to that engine, but you also have to help facilitate access to it. You've got to protect what you have, obviously, as you begin to share. But the paradox in all of this is that you're actually protecting your IP if you're an IP centric company or IP intensive company or breakthrough company by actually sharing it, which is a bit of a paradox. And so I would help companies get comfortable doing that, teach them how to protect it, and then invest with them in actually scaling. And that's how I got into the business of what I like to call IP investing. It's still venture capital investing, but I look at the engine in the car, the IP, as the primary decision maker and whether or not I'm going to partner with a company and invest in what they are doing. I also took that further over my career into things like wireless, the wireless in your phone. It's a technology called OFDM, orthogonal frequency division multiplexing. And basically, that's a superhighway of signals that you cannot see that carry data at the speed of light, bouncing off buildings and walls and windows and into your pocket. And we could take the physical on one end and at the speed of light, send it to you and turn it into the physical on your phone. And that is a magical thing. People often take that for granted. They don't realize what's really going on and how hard it was to make that possible. So I help companies like that. That would be one example. And so I began to realize that a new model was needed, like the model I had developed with these companies, where we could share in revenues with companies instead of equity, and we could help them protect what they have and license what they have. And that began me down the journey of what today is called IP capital.
Yeah, that's certainly a very interesting story, and I'm very intrigued by the concept of IP capital, like you mentioned. So, to explain it in layman terms, what is IP capital, how it works, and how is it different from the venture capital model?
So IP capital essentially is venture capital in its broadest sense. We're focused on helping companies with breakthrough technologies grow. But instead of focusing on software companies, which is where venture capital is mostly moved to, we're focused on hardware companies. We see a big shift from software back over to hardware. Software is useless without good hardware. And a lot of that has to do with bringing the cost of designing something that you would do in software into a piece of hardware. And I use hardware loosely because I don't mean hardware or computer hardware. I mean anybody who has something breakthrough that's building a physical product. The world is now shifting from the digital and the software products to the physical products or the hardware products. And so IP Capital was designed to meet a number of pain points that companies have and investors have in venture capital more broadly. But its focus is hardware companies. And instead of owning equity, because equity doesn't make sense, and we can talk about why that is, we're actually owning a share of revenues in these companies. So that actually is more attractive to investors. They want a cash flowing property. I like to call it an IP property. These companies to me are like IP properties versus a lottery ticket where they hold equity in a software company or digital products company. And that will allow many, many more investors to come into a market, companies building real physical products based on breakthroughs that are needed to really accelerate the growth of these, quote, hardware companies because they struggle to get the capital they need. Venture capital has built their funds and kind of their focus around software companies. So it's hard to get that capital. And when that capital comes in, it's very expensive. So in its essence, I'm a hardware company investor, which means companies building real physical products because that's where the engine in the car is. That's where the IP is. And I focus on IP. So I'm a venture capitalist, a new kind called an IP capitalist who cares about the engine in the car, the IP. And that becomes both the security for my investment, so I'm asset backed, and it becomes the way I create cash flows, right? By scaling the use of this IP, meaning the company building its own cars, its own corporate stores, to use an analogy, and then sharing that around the world through licensing and franchising arrangements. We're actually able to build a company that's more attractive to investors because it's cash flowing from the use of the IP, because we share in revenues instead of holding equity, and it's secured because we hold the assets as security for our investment, just like in a real property investment, versus venture capital, where you're pretty much riding unsecured for 10 years or more, and typically that lottery ticket does not pay out. So that's IP capital. IP focus on the engine in the car, back the investment by the assets that are needed to actually build this new widget, this new breakthrough product, and then share in revenues instead of equity. Investors are more secured. They have an income producing asset that they're investing in, and companies like it because they're not in a position where they have to give up most of the equity of the business to be able to scale their company, because we don't take equity. While it's an option, we like to focus in revenue sharing.
Yeah, that's certainly an interesting model. So is it like you're taking a stake in the IP, that you are a kind of partner in owning the IP? Is that what you're doing? And the other aspect is like when you talk about revenue share, uh, how is that structured? Because that's maybe an uncharted territory, because most of the venture capitalists ask for an equity share, and everyone knows that at what stage, how much equity you give up. And in case of a
Right.
revenue share model, how does that structure work? How does how do the numbers work?
So I'll kind of answer the basic question up front, which is what are you investing in the IP? And the answer is I am investing in the company, but the basis for the investment is the IP. So if you really want to strip it all away, I really am technically investing in the IP, and I'm making my decision based on the IP, the engine in the car. Is it differentiated enough? Number one. Number two, are the barriers high enough so that competitors can't easily replicate what you've done? And that's really important because venture capitalists focus on the team driving the car. That's primarily what they focus on. And while they focus on the innovation, they're not deep diving into understanding its value in any way because they don't hold it as security. They're really heavily focused on that team and that team's ability to execute. And one of the problems is that because they've taken this model and focused on software companies, what you learn about software is one, it's very, very easy for others once they see what you're doing to develop a competing solution. So the barriers to entry are low. That makes it a scary thing for everyday investors. And everyday investors don't want to play in what is a kind of a high risk lottery ticket investment style. And so, if you look at fund performance, and we can talk later about more of this over in the venture capital world, you'll see that because the barriers are low, even making a good pick up front on what you will invest in, because it's typically a software company, you're at high risk when 5, 10 years down the line, you're looking to exit, sell, or IPO that company. The returns won't be there. It's very easy to pump up the value from round to round. Everybody's motivated to do it because the VC or venture capitalist needs to watch how much he dilutes the company. He also needs to show paper returns to his investors right along the way. And so while everything looks rosy as you're growing your fund and making investments early on, because everything's done on paper and it's, somebody's valuation, right, in quotes. We all know that when these companies go to be liquidated, the low barriers to entry put them in a position where a lot of competition has emerged. You don't have that problem when you're an IP investor. It has something that's truly different, and this company has something that customers value and they can't get anywhere else. And the barriers to entry tend to be 5 or 10 years to actually do the deep science and engineering to independently develop a competing solution. So at core, I'm an IP investor, but in an abstract way, I am a venture capitalist, but doing things in a much better way, focused on companies that need my solution. Again, hardware companies or companies building real physical products based on breakthrough innovations.
Absolutely. And let's talk about the numbers aspect of it. How does the structure of this investment work?
So we come in and we have companies model 5 years of revenue projections. And of course, we don't rely on the business plan they give us. We're pretty careful because we hold security in the assets that are needed to build these breakthrough products. Companies are pretty careful to take those numbers and become really serious about what's deliverable. And I care about that because I want durable revenues. I'm sharing in that revenue stream. That's the way I get returns. So we start as a baseline with a kind of a 5-year model, and that drives everything. It determines what my revenue share is going to be. And the way I model is I'm just looking to get a 1x or 100% of that capital I've given you back over 5 years. So we can see the revenue path, and we can design a share of that revenue, a fixed share that will be low in terms of dollars early on and grow in its dollar amount as you scale this business. And I'm typically, because I'm getting 100% or measuring that royalty to get me 100% based on your revenue path, I'm getting a 20% kind of average yield, cash yield on my investment throughout those 5 years. When the company exits, and again, this is all kind of a baseline. We don't know exactly. It could be 3 years, 4 years, could be 7 years, but you've got to model 5 years. Anybody doing something breakthrough, they need time to work their way into the market. So a couple of years is usually too short. 5 years is really a good number for these kinds of companies. So we model where you're going to get to, and we bet on that revenue path. And again, we get what is really a return of 100% or equal to 100% of our capital over that 5-year window and a share of revenues. Again, that's an average of 20%. When the company exits, we get a 1x preference in the exit, and that's to return our capital. So we're getting a yield along the way, and we're getting our capital returned, kind of very much like an equity investor, but the way we're structuring it is really focused not on the team and the equity or the venture, but focused on the IP, right? And so we're essentially sharing in the value created from that IP, and we get our capital back when you exit. And then the third thing we do is we look at where your value is 5 years out, and we want to get a percentage of that exit that will give us another 1x. So over 5 years, we're modeling a 3x gross return, one along the way. one to get our capital back, and another one X that is a percentage of what the value looks like today going out 5 years based on where you believe you will be. Now, the beauty of this is if you compare the money coming in from a venture capitalist, if you can get it as a hardware company, it's expensive, and you can see that when they model a 10x or more, there's a big difference. One, I'm not diluting you at all in terms of what the equity ownership looks like in the cap table today. And when it comes time to exit, I've modeled a 3x overall. And over that 5 year window, the VC is looking to get 10x, and he's heavily diluting you in that ownership percentage. And everybody feels that pain today. And I want companies to be incentivized to grow and do the hard work to build that business. So I've designed this model based on 20 years of a lot of experience representing and working with and investing in breakthrough innovations for companies that were big and small, and I understand the pain points. And so the model, IP Capital, is designed for these kind of physical products companies, these hardware companies, to really address those pain points for the company, no dilution in their equity ownership, and for investors, a cash flowing, asset backed investment that looks like a real property investment, so they can really start to come in greater numbers to really propel what is the future in the world. Hardware companies, there's lots out there people can read about how the world is moving from software back to hardware, and I've designed a model to really help fuel that growth.
Absolutely, that's very interesting. And one question that popped up in my head is, how does this compare to maybe debt? Right? Let's say there's a hardware company building a product, and they have the option of either raising debt or maybe going the IP capital way and raising money from you. And even in debt, they'll need to pay back the money at whatever interest rate, right? But they'll be paying back about 100% of that on an interest, of course. But with you, you are getting a revenue share. So maybe is this might be more expensive for them. What do you think?
No, it's not actually, because I'm really an equity model in terms of the kind of risk I'm taking. So I'm sharing in revenues, and so I rise and fall on the success of the company. There's no fixed interest payment. Number one, if you're not worried as a company that as you're growing, predictable quarterly revenues and returns can be challenging. You can look out over 5 years and get where you're headed, but if you have to make a fixed interest payment, couple of things happen. One, you're not going to be able to take the kind of capital that I can give you. You can't afford to take it, and you can't take the risk of that fixed interest payment. So debt really isn't a solution. It's mostly used in venture capital to bridge a company like today when we're in a downturn to a time a year from now when valuations are up again and they can afford to take in the capital, right? And so venture capital mostly uses debt as a service to bridge between rounds. It tends to be low dollars, not the kinds of big dollars that a round would bring in. I bring in the big dollars that a round would bring in, and I carry you forward in a way that will really grow the company and really encourage customers to sign those contracts. Customers typically will not sign unless you have that big ticket of capital, and we gate it in against milestones, contract based or otherwise. So we're pretty smart. Durable revenues are pretty critical. But again, I'm an equity investor in the conceptual way of, yes, I am betting on the outcome. If you don't perform, I don't perform. So I have to be very careful in my underwriting to make sure the revenues are durable and to make sure I have enough value in that asset if something were to go wrong that we didn't predict. That is not a debt investor, right? Again, a debt investor is low dollars, bridge to the next round. And you can't afford much more than that as a company because you don't want to take the risk on that interest. And then you actually have a hard maturity date, a balloon payment, 3 years out, 4 years out, 5 years out. There is no balloon payment. In fact, because of my revenue share, I don't determine when you have to exit, which is something that happens if it's debt. And I don't determine when you have to exit, which is definitely something that happens when you take venture capital. They have funds, and these funds are modeled around selling off that equity and developing a return for their investments over a 10-year life to a fund. And so timing that the fund has can get in the way of the proper timing for a company to exit, go public, to be sold. And maybe the company doesn't actually want to exit. They want to bootstrap their way and build a business. They've got enough cash flow to do it. And so I give companies all that optionality. So I am I'd like to say venture capital in a brand new way that's good for investors, good for companies, and certainly doesn't hold you to fixed interest or maturity dates. So I would say debt is completely orthogonal or irrelevant to my solution as a competing solution.
Absolutely. Yeah, I love that answer. Great. And one more aspect I wanted to
Sure.
talk about is like in the broader landscape, like if you talk about the global landscape, why are these kind of businesses that are basically breakthrough innovations, why are they necessary in the global landscape, and why are they necessary for America, and why we need to have more of that in America?
So innovation, breakthrough innovation, is the single most important way for growing an economy, whether it's a country, a community, a city, a village. And the reason for that is innovation allows us to do things more productively. That means that whether I'm making a widget or I'm writing a paper or I'm giving a speech, whatever it is that I do as a company or as an individual, tools are given to me to do things more efficiently. And so breakthrough innovations, whether it's in how I can make more efficiently, right, as the manufacturer, or how I can use that product more efficiently, it means that I can create more value for my company or through use of a product if I'm a buyer for myself and my business than I could create before this innovation. And that means profitability grows, number one, right? I'm higher profit if I can do things at a lower cost to manufacture. That's an efficiency play. Or if I can get more value out of a product that allows me to do more for my customers, as a buyer of this breakthrough innovation, I can make more money as well, more money per unit of time. I can do more things for more people per unit of time. So my revenue goes up, my profits go up, and I'm a business that is more attractive to more buyers. So my share of the market goes up. So now I have a high profit, high growth business. And that's the magic here of investing in companies with breakthrough innovations that are building real products that are changing how we make things and how we use things. So I can do more things and make more money per unit of time. You can call it more efficient, more productive. And that's the magic. That's how economies grow. And that's why it's so important to invest in them, these breakthrough innovations.
Right, absolutely. And talking about like again comparing it to venture capital, so
Right.
you've said it that IP capital turns venture capital and big tech Silicon Valley on its head, right? So what makes you say that?
Well, venture capital is a basketball team, a whole bunch of basketball teams, and they're competing in a market that's saturated. And so there are lots of VCs, lots of venture capitalists, from the storied ones to the startup venture capitalist. And so what you see is too many venture capitalists are chasing too few good deals, and they're chasing those deals in a I'll call it a software realm where the barriers are low and it's very hard to get the returns uh, for their funds. And so venture capital has been underperforming because that lottery ticket is not paying out. And if you look under the hood or look under the gloss that you read in the press, you'll see that the cold hard facts are that they're underperforming. And the reason for that is like any market, and I'll use a good example. 20 years ago, America moved its manufacturing offshore. Why do you think they did that? Well, everybody could make that widget. And so the innovation was no longer proprietary, right? Everybody could do it. And so what happens when everybody can do it? It's a race. It's a race to the bottom, and everybody lives on cutting price, and they all live just above what's profitable to sustain their business. So that same analogy can be brought into venture capital. Because 20 years was spent kind of digitizing the world, bringing companies online, developing software solutions that would run on computers in your phone, your laptop, your desktop. That's where the funds have emerged, and there are too many venture capitalists chasing too few deals, again, in a software realm that has low barriers to entry, and they're not getting the returns. And when you move over to hardware companies, you're moving into a realm where the barriers are high, the profitability is high, the growth is high, because they're changing these companies through breakthrough innovations, how you make a product so it's more efficient to make. That means more profitable, right? Lower cost, higher profits, and you can deliver more value to your customer, either in more performance that comes from this product or in a lower price, right? And they can get more out of that product. So when you move to hardware and to a venture capital model called IP capital, where you focus on the engine in the car, the IP, you're in a realm where the barriers are high, the value of the asset is high, so you've got real protection, and the revenue streams, if you do your job right in underwriting the contract base these companies have to show people really see the value the company tells you they have, you're actually creating a durable revenue stream, and you actually have something you can count on over 5 years. In fact, it's conservatively modeled such that those revenues could certainly go far beyond what you've modeled, but you've got that durable revenue stream. So I'm bringing investors into an alternative way of investing in companies in a market that isn't saturated with a style of investing that protects their capital and is income producing. It's what makes IP capital so powerful. And the only reason the opportunity exists is I lived in that realm. I could see the pain points and I could design a problem. I could think outside the box. And when you're in venture capital, everybody's living in the box. I'm being cute in the phrase that I'm using, but they're living in the box. And it's very hard for investors in that model, very hard for venture capitalists to move outside the box. I've created a model that allows you to move outside the box, that addresses the investor's pain points for coming my way, it addresses the company pain points. And so that's why I'm turning venture capital on its head. And I think that the reasons I just gave really stand out, and they stand for themselves. I think it's pretty clear.
Absolutely. Yeah. Love that answer, and love the entire concept of IP capital investing. Definitely something new that's there, and I think definitely something that's worth paying attention to. Great. So one more thing that you mentioned somewhere on your website, that this model, IP capital investing, is also recession proof. How's that? How's this recession proof?
Well, I hate to say it, but it's pretty common sense when you hear what I'm about to say and you kind of unwrap it. So in a down economy, a recession, market prices in public markets drop because everybody is just dropping the multiples they'll put on earnings or revenue to value a business. It's an emotional response to a downturn. Valuations fall, stock prices fall, valuations for venture firms or venture capital companies or young companies, emerging companies, and then also public companies. And so everybody just kind of follows the herd downward, right? And the reason for that is that a lot of that is essentially emotionally driven, right? It's when everybody feels there's a downturn coming and the numbers show it, it's a self-fulfilling prophecy and everything falls. And so if you're an equity investor, you're basically stuck and crippled by whatever's happening in the world. You're correlated to what's happening in the world, and that's the word that investors would use. You're correlated to the state of the economy. You're correlated to what's happening in public markets. And so when you move out of an equity investment style into a revenue sharing investment style, and you move from equity into revenue sharing, where the focus is on breakthrough innovations or IP, and you're betting on companies, real physical product companies, hardware companies versus software companies, Those innovations, as I've mentioned earlier, have great value. People want that value, and they will pay for that value even in a downturn. Because even in a downturn, it's not like my dollar that I have in my pocket goes down to zero. It may go down to 80 cents, 70 cents. But the beauty here is that people are going to spend that 70 or 80 cents on the thing that gives them the most value. And that's the beauty of these companies with breakthrough innovations. So innovation creates the kind of value you can't get anywhere else. And so it's my job to make sure that the innovation has that value. So you've got to look at the contract base and make sure people appreciate that value. And you can get pretty comfortable when you look at the pipeline, whether that value is going away in a down economy or whether people truly see that it gives them value they can't get anywhere else. Those revenues are not dropping and the high profits are not dropping at a downturn because of the value they can deliver to their customers. People are going to spend their 70 or 80 cents on every dollar they now have in a down economy. Again, they don't have that full dollar, but they're going to spend it wisely and they'll spend it on the things that give them the most value. And so if you're investing in that kind of company, innovative, highly innovative company, making real physical products, hardware companies, you're recession proof for that reason, number one. Number two, because you're not investing in the equity and subject to the ups and downs of markets and valuations, you're not seeing with a revenue sharing model, which is what IP Capital does, you're not seeing a drop off in the returns. Those returns are still coming in as cash flows. And that company is going to exit 5 years out. You're not stuck in an investment where you're crying about how the value has dropped precipitously. You're actually seeing those cash flows continue to grow. And that's why IP Capital is such a groundbreaking financial product to really carry not only America, but the world forward. And I'm going to say something else, a third point as to why it's recession proof. And it goes to the beauty of IP Capital. When you focus on companies that are IP properties, meaning breakthrough companies, companies with breakthrough innovations, building something new and different, right? That IP or that innovation, that technology, whatever word you want to use, and they're all synonyms, that technology not only creates value for customers, but as the team in that company driving your car with that engine in the car, that IP, creating value for your customers, you now have an opportunity with somebody like me who can help you protect what you have to scale. And now, instead of a venture capital model that kind of every 12 to 18 months is kind of building the corporate stores, one store at a time for the team that's got a plan to build corporate stores, over in my model, because I've been doing this for 25 years, we're not only going to build the corporate stores, we're going to license and franchise the use, and we're going to have many more teams around the world get that value. And just think about the power of that. The world can become more abundant because they become more profitable, because everything they can do with these innovations is more efficient and more effective. And therefore, I can create economic prosperity for the world, not just for the company, but I can de-risk the investment for the company and its investors by helping them scale. And the company's revenues, even though I started with a very conservative model in how I look at sharing in revenues, with my help, we can have a lot more teams doing a lot more with that IP, meaning building franchise stores or building their own cars with the engine in the car. And I can build a business faster with greater revenues that will deliver more value to investors in a more secure way than venture capital. It'll deliver more value to the company and its founders, and it will create prosperity in the world. So it's a win-win across the board. And those are the three reasons why IP investing or IP capital investing is recession proof.
Great. Love that. So moving on to my last question, which is about digging more into your story, wherein you successfully invested in IPs like PCR, OFDM, and more breakthrough innovations, and how that produced over $3 billion in returns, which translates into 112% annual return. So can you help us tell us more about your learnings by doing that and how that translated into you starting COTE Ventures?
So the company will start with PCR. So PCR, for those listening, they know it because we all had to take that test to travel anywhere, right? The PCR test. It's much, much more than the process of you had to go through to be able to fly somewhere. It actually won the Nobel Prize in chemistry, and it is a foundational technology behind the biotech industry. It allows you to see the DNA in the body, whether it's your DNA or a virus or a disease. And I can turn the needle, the DNA I can't see with modern equipment, into a haystack. It makes many, many copies of that DNA. So there's enough of a signal that I can actually see the DNA is there that I'm looking for a disease, a virus, et cetera. Once I can start to see the DNA in the body, I can start to develop treatments to save lives, right? Because I can associate them with diseases, DNA patterns. I can associate them with viruses. I can start to develop treatments that will help people, that will save people, save lives. And so the company that had this kind of diamond in its pocket, or the engine in the car that nobody else has, had a choice. Do I go out into the world and build corporate stores, which is kind of a venture capital approach, one store at a time, and I grow from there, and just depend on me and my team to build this business? And they said to themselves, well, I can't have an impact in the world, certainly, if I'm holding this diamond in the pocket and I'm growing at a snail's pace, one store at a time. So they obviously had a noble purpose behind the way in which they grew, but they also had a good business reason for it. They realized that an IP investing style, or an IP capital investing style of growing that business, which is really the roots for IP capital today, was much better than an equity style of investing or a venture capital investment style. If we have this diamond in the pocket, if we have something groundbreaking like PCR that can help people around the world, why don't we build our corporate stores and own the part of the market that's profit optimized for us, that our management team can handle? And let's have the courage to go share it with manufacturers around the world and build a business. We're sharing in revenues from the use of our IP around the world. And there is the inspiration behind IP capital, which is we're not just betting on the team, we're betting on the engine in the car. We're not just betting on the revenue path that you're going to give me that you say you can achieve, but we're going to get you out into the world. And because I'm a master at how to protect what you have, and the PCR story is a great example of that, we're going to go out there and build a bigger business faster with more revenue and actually lower risk for you, lower risk for the company. And the paradox is that you thought that holding the diamond in the pocket was the way to protect your innovation. Well, I have news for the world. The world is pretty smart, and there are basketball teams, football teams, competitors, I like to call them, around the world now who want to compete. And you're actually hurting yourself by not getting out ahead of that and sharing it, getting people hooked on the value you can help them deliver. One, so they're not developing their own alternatives, right? That's very important. But rather looking to you to be the innovator and to continually rev up, right, what you've delivered, because they can make money. They love that. And so this model of IP investing, or IP capital, has its inspirations, and it goes back to PCR. And I saw the power of betting on the IP, or the engine in the car, and sharing it. The paradox is, by sharing it, I'm actually protecting it. I'm getting out ahead of it long before anybody would want to steal it. And I'm helping enable its growth. And I'm actually going to build a bigger business, faster, stronger, with lower risk, with that philosophy. Again, the paradox is, you actually can protect it by sharing it. That is the thing that I learned, not only with PCR, I learned that with OFDM, which is the technology behind how wireless works in your phone. It started in Wi-Fi. It's now in 4G and 5G. And it's essentially, as I mentioned earlier, a superhighway that takes the physical, turns it into digital, into energy patterns, takes it in the airwaves wirelessly at the speed of light around the world, from one phone or one place to another, and gives us instant access. What a wonderful innovation. What a wonderful breakthrough, because now everybody can sell to everybody in the world. What a wonderful thing. My market today is the world. So that's another example where that company had to license what they had. They couldn't do it all themselves. And that's a deeper story, but my history, my career early on as a lawyer turned into an IP investor really starts with these kinds of companies and seeing the paradox that we could actually generate the kinds of returns that you mentioned, $3 billion across these companies across 20 years and 112% IRR because we were betting on things and doing things in a way that was contrary to the way people think. Hold it in your pocket and protect it, but really you're actually limiting yourself. You're not only hurting yourself and your investors, but you're not allowing the world to benefit from it. So that's the power of what I did and why those returns are what they are.
Absolutely. Robert, you've absolutely blown my mind in this episode. And I'm sure, even though I'm hosting this one right now, listening to you, I'm going to go back and listen to this all over again with the amount of insights that there are and how breakthrough this concept itself is. You're backing breakthrough technologies, but I think this concept itself is quite something, right? So thanks for sharing that. Now, moving on to our rapid fire round, where I'll ask you 5 quick questions about the fund, and you have to give 5 quick answers. Are we ready?
Yep, we're ready.
All right. All right. So the first one is, what are the sectors and regions you invest in?
Okay, so that's an easy one. So when you think about, I'm not a software investor. I'm not investing in companies building digital products. I'm an investor in companies building real physical products based on breakthrough innovations, breakthrough IP. You now know I'm in the hardware realm, the physical product realm. And so when you ask me what are my sectors, I would say where the demand is in the world for technology is transforming the way we manufacture and use products in every industry. So it is every industry, but my focus is the IP that is transforming how you manufacture or use products in every industry. And what is that transformation that technology is being developed, innovation or IP is being developed to unlock? Sustainable manufacturing, which means that I'm thinking about how do I use less oil and pollute less, right? But I'm thinking about being sustainable, which means I'm thinking about using fewer natural resources and polluting the environment less. And while people would think about that as green, and many people might reject the notion of green, when you unpack it, you realize that what we're talking about when we're investing in technologies that make manufacturing and use sustainable, we're making it more efficient. So I'm using fewer inputs. I'm being more efficient in how I use my inputs. And what's that mean? My manufacturing cost goes down, my profits go up, my ability to deliver value to my customers goes up. And so that's the power of IP investing in real physical products, making breakthrough, game-changing products based on innovative or innovations, IP that nobody else has. And the focus again is sustainable technologies, circular technologies where I can reuse my waste. One example would be a textile company that can take waste off the factory floor and they can turn it back into a virgin fiber that can be spun into yarns, back into a fabric. And then you can, if you're H&M or any other major retailer, make the same garment, but you can buy that waste for next to nothing. So what kind of profits can you make in a business like that? A lot of profit. And that's the power of sustainable and circular investing. It's across industries, and most companies today are under pressure from investors and from the public and from governments, whether it's regulatory today or not, the regulations are coming. They're all being forced to have plans and to implement plans that make what they do, manufacturing or use of a product, more sustainable, less impact on the environment, make what they do more circular, reuse your waste. And both of those are driving efficiencies that with these technologies create higher profit businesses and higher growth. And that's where I'm investing my money, right? Which is where the money is and where the durability and revenues are, because customers need this. It's hard to find it. They can't meet their sustainability and circularity goals without it. And when you unpack it, it's an efficiency play where the profits come and the revenues become durable. And that's why the IP investing style over in hardware companies or companies building real physical products is a breakthrough. And where I'd love to build an army, I like to call it Cody's Army. We are there not only with traditional backers, humanitarian fund, and some other institutional backers, but I'd like to bring everyday investors into this model because it is asset backed and cash flowing, and everyday investors definitely want that over a lottery ticket all day long. So,
Absolutely. That was a great answer. And just try to be a little more quick since this is the
yeah,
rapid fire round
sure,
and
sure,
we're going for the
sure.
close, right? So the next one is, what's the typical stage of investment?
So again, these companies need my solution early in their revenue path. So I'm not an early stage revenue, meaning a pre-revenue, early stage investor or a pre-revenue investor, but rather post-revenue or at or about revenues where I can get comfortable. These companies can drive forward that pipeline of customers and actually convert that into durable revenues. So early revenue, as a company grows, we can still participate, but I become less and less necessary because more traditional capital like private equity, et cetera, at least right now, can step in. I'm filling a need where the need is greatest, which is early revenue companies building real physical products that need a lot of money to grow. They can't get it from venture capital. If they do, it's very dilutive. And private equity, they're just too early for private equity. They're a year or two or more too early. They need to get further along.
Great. What's the typical check size that you put in?
So these companies tend to need 30 to 50 million dollars of capital. They're building out capacity to build that new product. Again, they're building a physical product. In contrast to a software company where I don't need a manufacturing plant, I don't need equipment to build. I just hit a button and I make a copy of that piece of software, or I click a button and download the software. Right. So the economics to grow a software company are much lighter by far than building a hardware company. And that's why my model, again, is so valuable, because taking in that capital when it's hard to get from private equity or venture capital, early revenue, when you're early revenue, is very, very expensive because the value on that early revenue company might be 50 or 100 million on a $5 or $10 million revenue ARR, right? Recurring revenue path. So I might get a 50, 100, $150 million valuation, but I might need 30, 50, $100 million. But I would say our average check size is 50 million. Companies tend to be in the 30 to 50, but those numbers can go as high as $200 million or more to build out a line. I have an opportunity with a glass company where every line takes a couple $100 million to build, and we're supporting that effort. But if they took that money, early revenue, in equity, it would be quite what you call a cram down. Everyone would hurt, both the founders as well as the existing investors. I'm solving a big problem in what I do.
That's great. Where can founders or innovators pitch?
So they can go to my website, COTE Capital, COTE Capital.com. They can email me, rcote, RCOTE, at COTECapital.com. On my website, we have a way to post or contact us. You can do it that way. You can go to any one of my social feeds. We're on LinkedIn, both personal, Robert COTE, as well as COTE Capital. We're on Twitter. And so you can go to any one of those channels. We put a lot of video up that's explaining all that we do in details that we couldn't get into in just a simple podcast. So I think people will find that encouraging. In my website, we've gone to great lengths to explain our process. So if you want to learn about our process, it's there. If you want to learn in detail why we're different than venture capital, it's there. We have a section on our difference. And if you want to understand our model and how we do things, not just our process, that's there as well. So you can both educate yourself and you can reach out to us. So I look forward to hearing from people.
Great. And the last one is, where can our listeners follow you?
Again, you can follow me on Twitter, Robert COTE or COTE Capital. You can follow me on LinkedIn, And I would say those are the two primary channels today. Or on YouTube, we have a YouTube channel as well. We're on Facebook and also Instagram. But I would say most of what we're doing is in Twitter and across LinkedIn and in our YouTube channels. And again, we've done a lot of video content. We've got about 100 different video clips out there on what we do, how we do it, that I hope will inspire a lot of people.
That's great. I'll make sure to put all those links in the show notes below. Thank you so much for making time for this, Robert. I absolutely loved talking to you and getting to learn so much from you. Thank you for coming on, and happy investing.
Excellent. Thank you. Bye-bye.